With record high coffee consumption in the US, is Starbucks the stock to buy now that it's down 30% year to date? Stick around to find out as we're talking about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we'll be analyzing Starbucks business and Q3 earnings results. We'll do a deep dive into the financials, the top line, the bottom line, especially the balance sheet, as they do have some liquidity issues I want to discuss. And finally, we'll conclude with an evaluation of this business using our intrinsic value calculator to see whether or not this is something we as retail investors should add to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we will be analyzing this business in 5 minutes. So let's jump into it. All right, so Starbucks, a specialty coffee realtor, and what exactly are they focused on? Okay, let's see right here, as reported by the CEO, the interim CEO, I should say, Howard Schultz, is that the company has a clear line of sight of what they need to do to reinvent the company, and that is to elevate their partner and customer experiences and drive accelerated profitable growth around the world. Okay, so that is clearly what they're focused on in the long term. Okay, and they've delivered record-breaking revenue performance during this quarter from continued strength in customer demand, coupled with their ability to execute investments despite macroeconomic and operational headwinds. So what they're saying there is that they've been able to produce a record quarter, even though they've had quite a few challenges, and we'll get into those challenges and actually right now. Global comparable store sales are actually only up 3% year over year, and that's driven by a 3% increase in average ticket. What that means is that they've increased the prices of their goods, and because of that, they're able to increase their sales by 3%. Internationally and abroad, however, we can see their comparable store sales actually decreased 18%, and this is driven by a 15% decline in transactions and a 4% decline in average tickets. So their prices are actually decreasing out in China and things like that, where they had to shut down a bunch of stores. There's a lot of headwinds over there because of that, a lot of impact. So this is going to be a bad report, we can already tell just from the very first page here. So for North America, we saw a change in comparable store sales up 9% year over year, versus this time last year we were actually up 84%. So a huge change there, and it's going in the wrong direction, unfortunately. Now onto the revenues here. They came in with $6 billion in revenue, which is up 13% year over year. So North America top line is doing well so far, right? However, when we get down to our operating income here, we can see that this is at 1.3 billion. Last year was also at 1.3 billion. So we're relatively flat year over year. And what does that translate to? Well, that translates to an operating margin decline of about 230 basis points. So basically 2%. So nothing to write home about just yet, but this is where things get worse, right? When we scroll down here and we get to their international segments. Okay, comparable store sales down 18% year over year. Last year, they were actually up 41%. So a huge decline there. Same thing with the transactions, changes in ticket, and that leads us to our revenues being down to 1.5 billion versus the 1.6 last year, for a total revenue count of 8 billion. And this still actually beat analyst expectations by about 20 million. But then we get down here to our operating income figure here of 135 million. Last year was 327 million. So it's a decrease of 60%. Not good there. And that is why their margins here have also declined to 8.5%, which is 1,000 basis point decline from last year's 19.4%. Okay, and again, they said that this is primarily attributable to COVID-19 related restrictions in China. They had adverse impact from foreign currency translation and things like that. So that's really impacted their international business. However, they did say in this report as well that they are expecting their international segment to actually overtake their North American business in the future. So that will be very interesting if that actually plays out. Now, onto the bottom line information here, we can see operating income altogether came in at about $1.3 billion. Last year was at 1.5 billion. So that's a decrease of 13%. Then we get down here to our operating margin. Altogether for the consolidated business, it was about 16%. Last year was at about 20%, a 400 basis point decline. And this finally leads us to our earnings per share figure of 80 cents. This is the GAAP earnings here, and non-GAAP is down here at 84 cents per share. So we'll use this for a calculation. But as you can see, this is representing a 19% decline almost year over year in terms of earnings. So that is not good at all. All right, so looking at the balance sheet here, we have cash and cash equivalents. Let's call it 3.2 billion when we add in their short-term investments as well. Scroll down here to our debt figures. Short-term debt of about 1.2 billion plus about 14 billion in long-term debts. Let's just call it $15 billion of debt here on the $3 billion of cash. That's not a good look here on the balance sheet perspective. Now, the debt figure is not terrible at this point, but considering they only have about $3 billion in cash, $15 billion in long-term debt. They have about 5 times the amount of debt that they do cash. That's not necessarily a good metric that I want to stick with here for an investment that I would be interested in. But if we look at their assets here, 28 billion, current assets of about 7, yeah, we can say it's okay, it's serviceable. But when we look at the equity figure here, it's actually a shareholders deficit here of 8.6 billion. So that's something to take note of and keep watch of as these earnings results progress. But do keep in mind, we do want to see this figure trending in the opposite direction. Now, onto the statement of cash flows here for Sbux. We drag down our net income figure here of $2.4 billion for the quarter. We add back in depreciation, amortization, all the other non-cash costs, and we get to 3.2, let's call it $3.3 billion in operating free cash flow. Deduct our small capex figure here, and let's just call it about $3 billion in free cash flow to reward shareholders for the quarter, which is actually pretty strong. All right, and what exactly did they do? They've taken on a little bit of debt here, as you can see, and then they paid out a nice dividend, and they've actually repurchased some more shares of stock. However, the only thing I'm not too happy with is that they've actually taken on debt to actually service the dividend and buy back the shares. So ultimately, it's not the worst thing that a business can do, but what I would prefer as a value investor is that I would want to see that the business can actually afford their dividend and the buybacks with the cash that they've generated for the quarter alone, not by having to pull out debt. All right, so now if we look at their earnings per share forecast, as the company has actually suspended their guidance for the year, we can estimate that they're going to come out with an average of about, let's call it $3 in earnings per share for 2022 on an annualized basis. So if we plug that figure into our calculator, we require a 10% return. They do actually pay a dividend as well. If we expect long-term for the first 5 years, 7% earnings growth, and then that's normalized at 7% on a 20 PE, we can expect this stock to be worth about $72 per share. We're currently at 83. Now, this is a conservative estimate, so take it with a grain of salt. Now, let's be optimistic and say that they can actually grow at around 15% for the first 5 years. Let's say that we have a turnaround, especially in the international business, and then that declines to, let's say, 9%. On a 25 PE, this stock would be worth $126 per share. And in the very worst case scenario, and it's very unlikely, but that Sbux cannot grow anymore for the next 10 years on a 15 PE, the stock will be worth $37. So for me, and especially with the PE sitting at 22 and the price to book value actually being negative here, I'm going to pass on investing in Sbux just because I want to see the stock price come down just a little bit more. I think it's a little too high for where it currently is sitting. I think that the equity along with the debt figures in the business currently doesn't look too great. I also don't like the mantra of taking on debt to pay out dividends and buybacks. And obviously things don't look good internationally. However, if internationally they do see a rebound, we will see some nice stock appreciation as we have in the past. If we look at this from the max point of view, we can see this stock has compounded investor gains year over year over year. So while I don't think Sbux is a bad business, I think they just have some issues that they need to deal with before I can get interested. But again, as always, please do not take my advice for it. Do your own due diligence and your own research. That is just my analysis for today's stock, which is Sbux, ticker symbol SBUX. If you enjoyed the analysis and the value investing perspective, once again, please leave a like and drop a subscribe, and I'll catch you on the next one.